Hello, my friends. Today's 2-minute tip is about debt to income ratio. Now, people in the industry call it DTI, and a lot of times we hear that and it's like, what is that? This is an important calculation for lenders to be able to look at whether you can afford to get a mortgage if you qualify, or how much house you can qualify for. So what you do is you take your debts, your housing payment, whether you already have a mortgage or you're looking at a rent payment, your car payments, any student loan debts, maybe child support payments you have to make, and any credit card bills or other types of debts like that. You add those up, and then you divide it by your gross monthly income. That's before taxes and deductions. That will give you a percentage of what your debt to income ratio is. Lenders like to see, as a good rule of thumb, 43% and no higher. Now, part of the debt to income ratio is front end and back end. So the front end has to do with your housing payments. That's your principal, interest, property taxes, homeowners insurance, and if you have HOA dues. That all gets added together, divided by your gross monthly income. That gives you a percentage. We don't want to have it any higher than 28% if we can do that. Back end, you take all the rest of those debts, do the same thing, divide by your monthly gross income, and you get another percentage, and they don't like to see any higher than 36%. So one of the things to consider when you're out looking for a house, if you see a condo or townhouse you like, a lot of times the prices are a little lower, and it's nice to have the amenities. You have to take into consideration those HOA dues. That goes into your debt to income ratio. That is added to your housing debts. So your mortgage, the property taxes, the homeowner's insurance, and then they put the HOA dues in there. That might bump you out of your price range. It's important to go meet with a lender. This is Karen Miller, your real estate broker with Keller Williams Realty Eugene Springfield, 541-221-1805. Thanks now.